Hello, YouTube. We're looking at an ETF here called a meme, M-E-M-E, which shows us that meme stocks, a basket of stocks, is up by 69% year to date. And the reason why we want to look at this is because when we look at the 12-month chart, we know we're here at 42. We have 69% year to date gains, and it's telling us that meme stocks are back, raising a red flag for the broader market. The S&P 500 trades lower when gap between meme stocks and staples widens. This is often the tail end of the move. So what we've been talking about for the last bit on the S&P is just that it appears like we're starting to feel a little bit exhausted. And the range on the day is actually quite small today. It's under $2. We're right on our uptrend. There is not yet a signal or confirmation that we are going lower. I just think we're due for a move down. This article is from July 11th. So we've been due for a while, right? The market can remain irrational longer than you can remain solvent. But let's just see if we can actually get a little bit of a sense on what is actually happening here. As a follow-up to the article we talked about yesterday from Tom Lee, he's also talking about how there's a well-telegraphed pullback will likely be shallow. We showed that seasonality chart yesterday too, where that's what we were looking for. And then down here, they actually provide some indicators. So again, that seasonality chart we're looking at here just basically tells us that for the month of August, we're looking for a little bit of a move down. So we start the month off, which is basically today, by going down. That's a check. Dead cat bounce up and then move lower. This could be earnings. It could be Amazon, could be Apple. I'm not 100% sure. We'll look at those few things in a moment. But if we look forward to here to support his case, Lee rattled off a batch of performance factoids, including since 1950, the average return of the month of August has been just 0.01%. Whoa, that seems like zero. That seems like nothing, making it one of the worst months for stock market returns. That seems like a lot of history, roughly 70 years, almost 75. During that period, the win ratio for the month has only been 55. When stocks fall in August, the average drawdown is 3.2%, and that would imply a roughly 150% return for the end of the month. Another interesting caveat, stock market underperformance in August worsens the S&P has gained more than 50% through the end of June, which means we've already gone up more than 50% into the end of June, which means we could be looking for a drawdown of roughly 3.5%. Average return falls to negative 1.4, and the win ratio declines to 40%. This will be very interesting because as we talked about for the last little bit, we haven't yet really had a true test. We've just been going higher and higher, higher. Pop flag, pop flag, pop flag, pop flag, pop flag. We're starting to flatten out for sure. I think we're flattening out. What I'm really looking for is a pullback to like test this 50-day moving average, which is about 3 to 4% lower. It's not like a huge drop. And if we look at the actual percent from where we are right now at roughly 4, 5, 6.5, we're looking for about a 4% decline to get to that 50 DMA. So if sometime during the month we curl up higher, we come down for a test, that's what I'm looking for. It's like really important. I think we would really like to know where support is. Before we go further, I'm going to ask you for a huge favor. If you could please consider smashing the thumbs up and subscribing to the channel, I would greatly appreciate that. And what I mean by this is that the stock market usually takes a staircase up and the elevator down. So we've been staircasing higher for quite some time. I'm just not really sure where support is on the daily chart. So we got gaps, we got a gap, we got a gap, we got a gap, we got a gap. We got like 5 gaps here as we go down to our move off the low. Another gap there. It's not unhealthy. But I would be much more confident if I could see these numbers actually playing out. So if we go back here to a hollow candle, the first warning is going to come if we actually don't close with a hollow candle. That means that we have to close above 458.16, and we also have an inside bar. We're battling for 2 weeks ago high at 456.43. It's almost exactly where we closed out. So what does that mean? We're trying to decide if this is support or resistance. Why? Well, remember, Head and Shoulders is formed by 3 candles with 1 high and then 2 shoulders. So if we look here now and we flip to a line chart because we're looking at let's go to a candlestick. There we go, hollow. If we fall back below here into a close, meaning 456.4, that would be a really small Head and Shoulders. That could, again, keyword being could, be the start of a contraction because the expansion might be over. So if we don't get another hollow candle, I don't know if the expansion is going to continue. We don't yet have a lower low though. So we have to fall below 451.77, but also below our 78% Fibonacci level, which I've been talking about for some time, which is why there's that question mark there. So until proven otherwise, this is bullish, but we can also note that as the price goes higher, the thing that is lacking right now is fresh bullish volume. Volume is actually pointing down. It is elevated compared to the red bars, but there's only one poke up here to the 50 MA, which means we're seeing below average volume. That is normal for the summer. So we can put that with a grain of salt. I just want to be mindful of it. Let's read this next article to see if there's anything else we can glean from it. Stocks are doing so well, it may be time to start worrying. Cool, right? There you go. Why? Because you buy insurance when you don't need it. And as of right now, we note that the fear and greed index is now ticked back down to 77, basically flattening out from yesterday. We were higher a month ago. We were higher a week ago. But the price, meaning this price on SPY, the price on QQQ, is still doing perfectly well. So I would say that we're at risk of going lower if we fall back down into greed. And that's just because if this is a momentum trade, it's a positioning trade. Well, we saw some massive orders going through yesterday. This is just week to date, to close the month out. And we're seeing like $350 billion transact. A billy for Apple, Microsoft, QQQ, and then 800 million for like a lot of individual stocks. So these are mostly closing out on the 31st, right into that final hour. So a lot of people are trading hands, meaning the stock is trading hands, and we just want to be mindful of a few things. So protection cost is the lowest since at least 2008 per one measure. What does that mean? Insurance has not been this cheap since 2008. Again, one more time. When do you buy insurance? When you don't need it. So right now, you don't need it, and it's really cheap. That's why it's time to maybe look at it. I would really encourage you to make sure you're prepared for the downside. The odds for August are the worst month of the year. So like if it's the worst month of the year, we're having the lowest level of insurance going back like 15 years. Maybe it's something to consider. I'm not saying we're going to tank or we're going to go much lower. We're going to have we're going to have to stop expanding before we go lower. We're going to have a warning before we get confirmation. So when an expansion stopping just means that for 1 week, we take a breather, right? We're no longer going up. There's no longer fresh highs being made. There's not a hollow candle. A lower low is a warning. 2 lower lows is a start of a trend. So we get a warning no earlier than this Friday. We get confirmation no earlier than next Friday. That would be the 11th. That is almost halfway through the month. So that's why, again, is it time to start worrying a little bit? Well, as we know, we climb the wall of worry. We find more things to worry about. So let's just see if we can actually understand what it tells us here. U.S. stock market traders are almost completely fearless now, which has some strategists bracing for a possible sell-off. And I noted that fear and greed indicator as well. Cheapest you likely have ever seen since Bank of America. And a Tuesday note, trading volume on call options used to wager on the market rising outpaced puts early this month by the most since December of 2021. Remember what happened in December 2021? I do. Oh my goodness. Was that to top? Was that the all-time high record close? That's right. So we had the end of December, beginning of 2022, looking all the way up to here is our all-time high. Well, after that, insurance got a whole bunch more expensive because we went down. So let's just be very, very mindful. History does not repeat itself, but man, it looks like it might be rhyming here. So as we look forward here to the next line here, what does it tell us? It tells us, but there are reasons to be worried, blah, 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 blah. Bullish sentiment and weak seasonality has some contrarian antennas tingling a little bit. That's exactly what I've been talking about. So FOMO players are all in now. So that means it's time to see this rally pause. There we go. Surging demand for calls. Look at that. Higher highs, right? Making big booms. Jumping down here, we can also note that seasonality snaps, the same thing we looked at in the Tom Lee article. August is the S&P's second worst month on average in the past 3 decades. He went back to 1950. Here we're going back 30 years. Hey, if it's the second worst or worst month of the year, maybe it's time for us to be a little bit mindful of that. And the reason why this will be very good is because, at least on a weekly chart, if we got a test of this uptrend, which is only at about 445 right now, or back testing those monthly breakouts, and we bounce there, meaning we bounce off our weekly uptrend, I would say we can say there's support at that area. Right now, the problem for me is this. We look here to our monthly chart. Well, like support is down here at about 437, and I don't know if that tests and it's going to hold. If that doesn't hold, the next shelf of support is down here at 417. We also have our 432 high, but like we're talking many, many points lower. And because the high from last month is 45944, and we're currently at 457.2, if we don't get another hollow candle on the monthly, or we signal the expansion's continuing, I'm being very mindful of that. Why? One more time, if you look back to here, we have a pattern where we go, we crash line onto the 50 moving average. So we have this 2 candle pattern right here, 2 candle pattern. We bounce off the 50 MA, we bounce off the 50 MA. We have a little bit of a deviation here because of SVB, Silicon Valley Bank. But then we have 5 back-to-back hollow candles taking out the relative candle high, that 432. Same thing happens here. We have 5 candle expansion. We go to a higher high, turns into a bearish engulfing, and then we go higher to all-time highs. So this is the period I'm looking at right here. If we can't form a monthly higher high, I'm not sure the monthly expansion is continuing. That's the number one thing to look at. So if it's literally that simple, we wait till we get to 460 and hold it on a weekly close, I'll feel more confident buying over 460. Otherwise, if it's up to 460, or we can make about 3 points to the upside, but our downside areas are, so we got 3 if we go up. If we're wrong, what do we got? Well, it's like a lot lower. We got 437, 417. So that's either 20 to 40 points. So if we're looking to make $3 and our risk is 20 to 40, maybe it's time to be a little bit worried, as the title of the video suggests. So let's get this thing wrapped up and get you ready for the rest of the week, because there's still a lot for us to go through. So we got some earnings after the bell today, and if we have a look at the S&P net, it's basically flat, which means earnings right now were not the catalyst, at least right now, because we had AMD out, Starbucks, Pinterest. What else do we have? Is today Tuesday? Oh, today is Tuesday. All right, so with all those companies out, the S&P is not really moving. I think it's going to really come down to like what happens on Wednesday, but also on Thursday. So if earnings right now were not all that bad, what could be the catalyst? Well, it's a lot of money trading hands. We're talking about hundreds of billions of dollars in lit pool and dark pools since yesterday. That's right, in 2 days. It's massive, talking billions each transaction. Fear and greed is almost back down to neutral here. And I think that's something we have to look out for. So if we pop over here to QQQ, the reason why I'm looking at this one is because we're noticing things are a little bit different. Where we have that same monthly inside bar. We're a little bit red, under $1 or 0.23%. We note that we are already a little bit red on the week with a full candle, which means a little bit of a move lower since the start of Monday. But the daily chart is what I'm looking at here. That same 78% Fibonacci area, which is roughly 452 on SPY-ish. If we were to drop down to the 50 DMA on QQQ right now, we're looking for a move lower about 4 or 5%. That's a pullback. A correction is 10. A bear market is 20. So it'd be a bear market if we slam down to that 200 DMA. It'd be a pullback if we go down to the 50 DMA or the short-term support, short-term price, which basically means testing this lower trend line here, right? Do something like this. Okay, cool. Then we go up. That would repeat the seasonality chart. So for SPY, what that would mean is like either we come down and test the just the uptrend and we bounce, right? Sorry, we go down to the MA, we kind of dance around here a little bit. And then if we can get back above 432 and 445, hey, gravy train continues. We're going to new highs. Otherwise, we're looking for strong support down here on our Fibonacci area, which is going to be our 61% Fib at about 430. That same area we talked about on the monthly chart. And that would be a really, really, really strong area to buy. That's our high going back to the summer of last year. So I think there's a lot of information for us to go through. Hopefully I dissected it and gave you an edge. But if not, please watch our weekend deep dive, which is now queued up here on the left-hand side, to give you my deeper thoughts on how I thought we could shake out this week and the major catalysts I will be watching. So with that said, good luck into the earnings release tomorrow and with all the economic data. Thank you for tuning in.